Start with you for this topic here. Why a dedicated P&L for a customer success team?
I have multiple answers to this, but I'll try to be succinct. So one, I don't think there's one out there that I could find. And as I was growing into my own leadership positions earlier in my career, I really wish I had an asset like this to really be able to go to the board, to leadership, and to have a seat at the table when it came to financials. Now that I am a customer success advisor to many companies at Growth Molecules, it's one of the top requests from our clients and CFOs. Not enough CS leaders feel confident using these type of models, and the how you use them, how do you forecast for the future is really important, especially when you're trying to think about, what am I going to invest in customer success? Is it in the people? Is it in the systems? Is it in the processes? If you have a model like this, you'll be able to make more quantitative decisions versus just guessing or past experience or what your leadership is telling you to do. Instead, you come to the table with the numbers and you can have a more data-driven conversation. And that's why you should have a model like this that you feel confident with.
And it's so important now, especially as CFOs get more involved. Like, we keep talking about the topic of durable growth. And I know our CEO, Nick, had put out a tweet a while back saying, basically, CFOs have a list of all the software vendors that they're utilizing right now. I want to see the value of these types of things. So being able to show as a CS team, hey, here's value we're getting as a team, not just as a piece of software that we're using on that team, but here's what we're giving back, is so crucial, especially as you ask for things like headcount and more resources.
That's right. Yes, and we'll walk through it in a moment. Really, this model, we created it for anyone who is a customer success leader and who wants to own the budget or who owns the budget and is making hiring decisions. And James, I will bring you in. I'd love for you to share, how do you use it? How do the people on this call feel really confident using the model?
And before you get in there, James, I just want to preface this by saying everyone will get a copy of this too. So no need for screenshots or anything like that. You'll be able to use this interactive model. So back to you, James.
Yeah, absolutely. Thanks for the intro. And yeah, this model is really it's designed to be interactive. It's a live Google sheet. So I'm going to kind of run through it and show you where you can configure it and put in your own data. And the idea is that by feeding in some inputs into this model, it will then give you some outputs that you can then go and have conversations internally with, with your CFO, CEO, etc. Obviously, when you build a model like this, you can't build it so that it's perfect for every company. So, I've tried to get the balance right between it being simple enough to use, particularly because I think, my experience, a lot of people feel uncomfortable with building complex spreadsheets. And so I kind of wanted to keep it as simple as possible, but also make it customizable. So it felt like kind of your company, right? Your business. And then if you are so inclined, you feel confident, you can obviously take a copy and make modifications and build on it further. And if you don't feel confident, we're happy to also help you with that. So I'm going to, if everybody's ready, I'll share my screen and start walking through the model.
Sounds great.
Okay. Right. Everybody see that okay?
Looks good.
Great. Okay. So what I've done is organize this in kind of a flow, right? So starting down here at the bottom, we've got some instructions on the first tab, and then we have step 1, 2, 3, 4, and 5 down the bottom. There's a last tab here with a couple of links out to resources that I thought might be useful as well. So I'm not going to run through all the detail of what's on this slide. You can kind of read it while it's on the screen here, but it's a good kind of point to come back and refer to just to remind you how the model works. But what we're trying to do with this model is tell a story. And this is a story that I found myself wanting to tell many times, multiple times as a customer success leader, which is investing in customer success. A customer success organization is going to pay back with a positive ROI to the business overall over a period of time. And, I think anecdotally, we all believe that, or most people believe that, but how do you show that with numbers? How do you convince people maybe that aren't fully on board, or that want to see more detail about how it's going to pay back? And that's really what this model is looking to solve. And the way I've built it is that it kind of imagines two scenarios. Those two scenarios can be maybe your current state versus a future state where you have increased investment, or it could be perhaps two different levels of investment. It's really up to you, but it basically shows how the future plays out in two different scenarios, and you can configure what those scenarios are. But before we get into that, let's start with tab number 1, which is the baseline data. So in order to make this model as relevant as possible to your company, it's necessary to tell it a little bit first about your current business. And you can see here there are 3 sections on the screen. The first one describes your current customer account portfolio. The second describes your sales targets for the year ahead. And then the third relates to the percentage of your revenue that you typically spend in different departments currently. So this is all like the current state, right? How your business looks today. So I'm just going to very quickly run through this, and then obviously we'll have room for questions, and I'm happy to also connect afterwards and LinkedIn, things like that, if there are follow-up questions. So we want to first tell the model when our financial planning cycle starts, and that just helps configure it, right? So not every company works from January to January, so sometimes it's nice to see it, your fiscal year reflected correctly, so you can configure that. Then we need to tell the model what our current subscription base looks like, both in terms of revenue and in terms of number of customers. We're just using obviously some placeholder numbers here for a fictitious company. I should have mentioned, actually, any cell that you see in this kind of light bluey color is a cell that you can change the numbers in or change the values. Anything else is locked down and will basically automatically calculate for you, okay? So we're just going to focus on these blue cells. So out of this customer base of 500 customers, the next thing is to tell the model how you would segment them if you had to divide it into 2 segments. A strategic segment, which typically would be your biggest accounts, and then a scale segment, which is just terminology that we've used here, which represents every other customer outside of the strategic segment. So what percentage of your revenue sits in your strategic segment, and what percentage of overall logos or accounts sits in the strategic segment? And this becomes relevant later in the model, and I'll show you how in a moment. Next, we need to tell the model when our renewal dates are. Now, for many businesses, this is probably going to be pretty flat, 25% per quarter. But some businesses I know are very seasonal, and you have like a concentration of renewals happening in a certain quarter. And this allows you to say, actually, I have concentration, let's say in Q1, and it will amend the distribution to make sure that the whole year adds up to 100%, right? So it's basically saying, what does that profile of renewals look like on a quarterly basis through the year? So that's the account portfolio. Let's move on to the sales targets. So, assuming every business has some targets for their sales team, the model needs to know what those are. So this is to allow us to forecast revenue for the future. Obviously, you've got existing customers and the revenue that comes from those, but you're also going to have net new customers coming into the portfolio. So what the model asks for here is, what is the goal for new business in terms of revenue per quarter over the next year? And then what percentage of that revenue is expected to fall into your 2 segments? And the reason I've allowed that configurability is sometimes a company might have a customer base that's maybe skewed towards smaller customers, but they know for the year ahead, they're going to aim to bring on bigger customers than they have been in the past. So they would skew more towards strategic. And that's what you're seeing here, right? 30% of the existing revenue is in the strategic section. but we're assuming 40% of new business falls into that category because we're going to focus more on that moving forwards. And then lastly, typical spending by department. This is something you can go and speak to your CFO, get this data, but basically you go and look at how much did we spend on support, let's say for the last 3 months or the last 6 months, and what percentage of our overall revenue for that period did that spend represent? And you just put that percentage in here. Again, we're having to assume that stays constant, it stays flat. That's just one of the sort of assumptions or limitations that we have to make to keep this model simple. But you can go and put those numbers in. And we've actually put numbers in that are fairly representative of a typical SaaS company, just to kind of hopefully save you having to, if you don't know those numbers, then at least you can start with these until you have the more precise data for your business. I do want to point out that you don't need to put anything in for customer success yet, because that's what we're going to do next. We're going to plan these 2 scenarios with 2 different levels of spend. All right, I'm going to keep moving. I know I'm going fast. If there are any time-sensitive questions that you need to shout out, maybe Tim, you could do that because I saved you.
A couple questions just came through chat here. Is the percentage based off of people and tools or just people?
This is total spend. So it would include both, anything that, support people and support tools, for example.
Okay. And then just one more question here too. We should assume, quote, expected % of sales by segment is by revenue, not by logo, correct?
Correct. Yes.
Awesome. Yeah. Cool.
Okay, cool. Good questions. All right, so now let's move into the scenarios. These are the 2 investment scenarios I talked about. So first up, we're going to tell the model how much we typically pay our CSMs, both for the strategic accounts and for the scale accounts. And then I've also put in CS operations as well, because I know that's a role that many success teams now have. So how much do you pay on average a CS operations headcount? This doesn't have to, again, this is a limitation of the model. It has to be kind of an average, but you'll see at the end that this doesn't have to be precise. It just has to be believable and in the right ballpark, and then everything kind of plays out nicely at the end. So first of all, the annual salaries, and then what percentage of time and resource does your CS team spend on retention versus expansion? This is an important one, because if you think about how customer success expense is viewed in a balance sheet by the CFO, it can go in one of 2 places. It can go in cost of goods sold, which means it's a cost of supporting customers, or it can go in operating expenses, which is where sales and marketing typically goes, which is usually more associated with growing the company. So there's a debate over that. Different companies put it in different places. A lot of companies now are splitting the cost and putting some of it in COGS and some of it in OPEX. So this is basically telling the model how you think about it. And you can't just make this up. Like, you should have a conversation with your CFO and say, listen, the team doesn't do, let's say your team does no expansion activities. It's purely based on retention. Well, then there's an argument that most of the cost should go into cost of goods sold. If, however, there's an element of what you're doing that is growing revenue, and whether you're directly responsible for expansion opportunities or not, then some percentage of that should go in the expansion bucket, which will go into operating expenses. So this is quite an important one. Again, it's hard, just kind of everybody's different, and that definitely warrants a conversation with your CFO just to get, again, something that's in the right ballpark. It doesn't have to be perfect, but in the right ballpark. All right, let's move on to the 2 investment scenarios. So we're calling scenario 1 and scenario 2. We can basically give them a name. So in this case, I've gone with base case versus investment case. You could call it, low investment versus high investment, whatever makes sense to you. In each scenario then, there's an opportunity to tell the model over the next 4 quarters how many strategic CSMs, scale CSMs, and CS ops people you have on the team. So in the base case, you can see here, we've got one strategic CSM for the whole year, 2 scale CSMs, and 0 CSOps. And then we're spending $5,000 per quarter on tech, other expenses. And that gives a total spend for customer success of around $77,500 per quarter. In scenario 2, where we're saying it's an investment case, we're actually increasing the headcount from 1 to 2 over the course of the year for strategic. We're going from 2 up to 3 for our scale CSMs, and we're adding in a CS ops person in the second half of the year. In addition to that, we're spending 3 times as much on technology. So maybe you're gonna purchase Gainsight, right? And that you want to build that into the model as well. In this scenario, all of you have Gainsight, so that maybe you're going to spend it on something else. And you can see how it impacts the total expenses. So what you're basically doing here is profiling the investment, the expense that you're going to that is represented in each of these 2 scenarios. What happens next is the most important piece, which is, what do you think the impact is that you can have on retention and expansion in each of these 2 scenarios? Okay, now when you're doing this, the important thing is to make it believable. It's really easy to kind of put in really kind of stretch goals or ambitious numbers, but it will just make the model less believable, and you'll have more people kind of poke holes in it, and you might not be successful, therefore, in getting the investment you need. I always take the approach of making it conservative, make it numbers that people can like really not argue with. It's like, yeah, that seems perfectly reasonable, that assumption. You can always aim higher than that, but then this becomes kind of the worst case scenario, right? And if the worst case scenario looks good, imagine what the best case scenario will look like. So what I'm showing here is, in the base case, we have a 93% gross revenue retention from your strategic segment and a 90% from the scale segment. And this would typically be based on your historical numbers, you know, from recent quarters. Again, speak to your CFO to get that data. So then the question is, if I had these additional headcount, what do I believe is going to be the impact on gross retention? You can see here, gross retention kind of steps up each quarter because I'm maybe in this scenario with that extra strategic CSM, I'm able to give more one-to-one time with my top accounts. So I believe I'm going to be much more effective at retaining those accounts. Maybe with the scale CSMs and the CS Ops investment, I believe I can drive up retention within the scale segment by putting in some digital CS campaigns, for example, right? So I'm making some assumptions, and there's no science here. This is going to, based on your experience, based on conversations with your peers in the industry, what you believe is possible. And the same data is needed for expansion. So what is your expansion right now as a percentage of revenue for each of those 2 segments? And how do you think that would look if you had that extra investment? Okay. So what you've basically done here is define 2 scenarios. You want to make them as believable as possible, based on your experience. You have to obviously use your experience to justify the numbers you're putting in here. But what the model is now going to do is it's going to show the impact on all the key SaaS metrics in each of these 2 scenarios, so that you can demonstrate the impact in terms of return on investment. Okay, before I move on, any questions?
No questions so far.
All right. Hopefully this all makes sense so far. Okay, so we spent a lot of time putting data in. Now we start to get some data out. So there's a lot on the screen here, but again, if you're sitting down with your CFO, this is all going to make sense to them. So what I'm showing is, for the next 12 months, it's basically a revenue forecast model. So you can see here, we've got 2 scenarios, the base case and the investment case. So if we just look at within the base case, which is these 4 quarters here, what was our subscription ARR, our total subscription stack at the start of the quarter? And then what is it at the end of the quarter is all the way down here. The way we get to that new number is basically the model is taking all the data you put in and it's calculating how much revenue is going to churn, how much expansion revenue you're going to get from your existing customers, and how much new business revenue is coming in from sales. And that will give the new subscription kind of run rates at the end of the quarter. And there's lots of data in between here. You can see kind of how it works. It calculates it. I'm not going to go through all that right now, but basically you can see in 1 year, you're going to go from 5 million to 5.9 million of recurring revenue in the base case. And then over here in the investment case, it's showing going from 5 million to 6.1 million. Okay. Don't worry about like, what does that mean? There's a nice sort of summary at the end of the model that will help kind of summarize this all in a nice package that you can discuss with your CFO. But this is a very common kind of layout for, some people call it like a revenue snowball. It basically shows how your subscription stack changes each month or each quarter over a period of time. So you start with 5, you lose some from churn, you gain some from expansion, and you gain some from new business, and that's then where you end up. Okay. Let's move on to the next tab, which is a profit and loss statement. So again, this is part of any CFO's kind of end of every month, they'll be producing one of these statements and presenting it to the board. And this has not just revenue, but also expenses on it as well. So again, we got the 2 scenarios, base case and investment case. On the base case, you can see by quarter how much revenue is coming in. And you'll notice this is different from subscription ARR. Let's say you've got a business that does $5 million annual recurring revenue. Your income, the actual cash that comes in during one quarter, is obviously going to be a fraction of that. So this model calculates what that would be based on the numbers that we looked at on the previous tab. And then it calculates how much money you're going to spend in the quarter on the cost of goods sold departments, which are support, infrastructure, and the retention portion of customer success, which is what I talked about right at the beginning. That gives you your total cost of goods sold. The difference between that and your income is your gross profit, and that as a percentage is your gross margin. Okay. So that's your gross margin. And then you move into operating expenses. Again, the model is taking the percentages that you put in on that first tab and using it to calculate the spend in the departments that fall under operating expenses, which includes the expansion portion of your customer success spend. That gives you your total operating expenses. So basically then you get operating profit, which is the revenue that take away the COGS and the operating expenses. And that's basically it's your cash. You can think of it. It's not quite as simple as that, but it's close enough to profit. It's real profit. So you can see in this model that in the first scenario, the company profit is about $1 million over the full year. In the investment case scenario, it's only $850,000, right? So that makes sense. Yeah, you've invested in customer success, so you've made less profit during the year. Now, the initial reaction to that might be, why would we want to do that? Why would we want to make less money in the year ahead? Good question. Well, the reason is that we are changing the dynamics of the business. We're changing the health of the customer base in a way that's going to pay back in year 2, year 3, and make a business that is a lot more valuable, that is a lot more healthy, that has better SaaS metrics overall. So it's an investment in the short term to create a business that is far, far more valuable. And that's what I'll show you on the final tab, which is this 3-year outlook. So here we're looking at what does this look like if you played it forward over 3 years? Using all the same assumptions that we've just been looking at, what would happen if you after 36 months of doing this? And I'm going to, in the interest of time, skip through a lot of this data. But basically, if you go down here, you're looking and look at these cells here. You can see that at the end of 3 years, in the base case, you'd have a company that had a revenue run rate of 8.6 million, that was growing at 20% year on year, that had net retention of 97% and a gross margin of 73%. Versus the investment case where the business is larger, it's 9.3 million of recurring revenue. It's growing faster at 23% annually. And it's got a net retention rate, which we all know above 100, higher is better, but above 100 is an expanding customer base of 105%. Now, the trade-off is the margins are lower, but in my experience, these other metrics are far more impactful when it comes to an outside investor or maybe a potential acquisition, looking at the value of the company. These are the things that the CFO and the CEO will care about, right? This is a far more healthy business and an exciting business and a valuable business because of these metrics. You can always do things later on to improve margin, but the health of the business and the health of the customer base here is substantially better. And what that means is typically it will be valued higher. So the way the companies get valued, typically, again, it varies, but for simplicity here, we're assuming it's a multiple of revenue. That multiple, again, there's no science here. This will vary from time of year, industry, et cetera, But let's just say very conservatively, you get a 4x multiple on this base case business. Is it reasonable to expect a higher multiple on this investment case scenario? Yes, it is, because the business is healthier, it's growing faster, and it's bigger. So I'd expect a higher multiple. But I'm only assuming 4.5 instead of 4. It may be higher than that, but let's just assume 4.5, again, keeping it conservative. In this scenario, this business will be valued at $42 million versus $34 million. So you've created nearly $8 million of incremental enterprise value over 3 years through this investment in customer success. And interestingly, the gross profit that you've made over that same period of time is pretty similar. So what that's telling you is that even though there was a bit of a hit in the first year, the customer success machine that you're building is actually paying back cash in years 2 and year 3 to the point where you're in a pretty similar position in both scenarios. So cash-wise, pretty similar, but you've created a business that is substantially more valuable as a result of investing in customer success. Now, again, all fictitious numbers, all made up. You've got to put your own numbers in to make this kind of more realistic. But hopefully this gives you a tool that you can use to start having these conversations with your CFO and CEO. I'm going to stop there and see whether we've got any questions.
No new questions came through, but folks, please put any questions you might have in here about the usability of it or how you might present this. But I just love how actionable this is. And I think obviously the hardest part here is trying to broach the subject with your CFO. And this gives you such an informed way to do that. So I love that aspect of it. And maybe obviously we're talking with a bunch of Gainsight customers here. So a question for you, Amelia, is kind of how are you able to leverage something like this with a customer success platform? How does one kind of complement the other?
I think it really starts with getting comfortable first with this model, making sure that it's the foundation of what you're forecasting. For example, do you even have the right numbers to plug in here? How can you build relationships with your CFO to get those numbers, for example? And then once you feel confident with this model, making sure that you can go to your CFO, vocalize what you've put together, and then start moving it into a customer success platform like Gainsight, so that you become even more sophisticated with your data again, so you're not doing having anecdotal conversations and making decisions that way, but rather making sure that they're quantitative and analytical.
Yeah, and there's just a huge shift right now in customer success, moving to a lot more quantitative versus qualitative, especially as it relates to value, but showing value of the team itself in this regard. So I think that's great. There's one more question in the chat. We'll get to that in a minute. Put some more questions in there, but I'd always love to end these webinars with kind of like, really how you get started. So if you were to boil this down into kind of 3 tips, how would you get started with utilizing this asset here? Whoever wants to go first.
Yeah, I was saying, first of all, make a copy.
James.
Make a copy. It's very easy. You can just go to File, make a copy, and then you get your own version that you can go and play with as much as you want. But I mean, Amelia touched on it actually. The most important thing is to become friends with your finance department, whether it's the CFO or maybe someone else in that team that you know and you trust and you can get data from, because there's a certain amount of input that you need to the model, right? And you don't want to just make up those numbers, otherwise the model kind of gets off to a bad start. We all know bad data in, bad data out, right? So get that relationship established with someone in the finance team. Maybe ask them to share a copy. It depends on the size of the company, but share a copy of the board pack or the accounts from the last period, so that you can actually see these actual numbers for your company. That's I'd say the first place to start.
I'll add that working with leadership to show what you're doing with the data to get more buy-in is really important. And this speaks to one of the anonymous questions. What if you don't have enough historical information about ARR to properly input that data? If you're using Gainsight, hopefully you can get that data to start plugging it into this model. But if you're not quite there yet, working again with your finance, with your leadership to get that information. Maybe you don't have enough access in your CRM to pull that data. Maybe your salespeople aren't putting the right data in your CRM. That causes data integrity issues. But your finance department has to have that data correct. Otherwise, how can they be charging the clients? So I think that's the second tip I would give, is work with your leadership to make sure you have that data in place. And if you are a brand new company, of course, getting historical information is difficult. But if you're a year in, you at least have a year of data that you can start plugging in.
Yeah, and I'd build on that actually. Even a CFO at a established company is not able to predict the future perfectly, right? They build models and they make assumptions. There are assumptions always made. So if you don't have the data, then make an assumption, and make that assumption based on maybe what you read from online or what you hear from peers at other companies. But then write down your assumption, so that when you're presenting it, it's clear where your assumptions are and where real data is. And assumptions might end up being wrong, and that's fine. You can amend them later on, as long as you're clear what assumptions you've made when you put the model together, and make those assumptions believable. As I said before, don't try to make this look like you're going to build the next unicorn in 12 months, because you might feel good, but you won't get that buy-in, because it won't be believable. So start conservative and build from there.
Awesome. Those are great tips. So to recap that, becoming best friends with your finance department, your CFO, getting their ear, working with leadership, make sure you're showing what you're doing to get more buy-in, especially, and then make it believable. I think that make it believable aspect is true across the board, because I know a lot of folks who are on this webinar right now are in that that early phase still, the scaling phase. So it's a perfect time to utilize something like this. You'll definitely get this recording as well as a copy of this. So definitely encourage you to play around with it. But James and Amelia, if folks want to get in touch with you, how might they get in touch with you, whether it's about this or other great things you're doing at Growth Molecules?
You can contact me at growthmolecules.com and James at growthmolecules.com. That's probably the fastest way, but we are also on LinkedIn and all the different social media channels out there. And we love talking about numbers and data and customer success. So we welcome your connections.